In March 2020, while the stock market was collapsing at a speed not seen since 1929, millions of investors were doing something that looked completely rational. They were buying dividend stocks, companies with long track records, decades of uninterrupted payments, the kind of stocks your father told you to own, the kind your grandfather never sold. And then, one by one, those companies started cutting their dividends. Not the bad companies, the respected ones, the ones that had survived the dot-com crash, the ones that made it through 2008, Ford, Disney, Boeing, Delta, companies that had paid dividends for longer than most of their shareholders had been alive. Gone. In weeks. And here's the thing almost nobody talks about. Most of the people who owned those stocks were not surprised by the market crash. They were surprised by the dividend cut. Because they had been told repeatedly that dividend stocks were the safe ones. So either everyone was wrong about that, or there is something about how dividend stocks actually behave during crashes that is not in the brochure. Setup. Here is what dividend stocks are supposed to do according to every personal finance article ever written. You buy a share in a stable, profitable company. The company sends you a portion of its earnings every quarter. The stock goes down, fine, you still get paid. The market panics, fine, your dividend keeps arriving. It sounds like owning a rental property. The market crashes, your tenants still pay rent, except tenants have leases. Dividends do not. A dividend is a choice. Every quarter the board votes to pay it or not. There is no legal obligation, no contract, just precedent, reputation, and the quiet social pressure of not wanting to be the company that cut its dividend. In normal times, that pressure works. Companies will take on debt to pay the dividend. They will sell assets. They will do things that probably are not in the long-term interest of the company just to avoid the optics of a cut. Which means in normal times, dividend stocks look incredibly stable. And in a crisis, that same dynamic turns into a trap. The mechanism. Here is the pattern. It has repeated itself with clockwork consistency across every major crash of the last century. Before a crisis develops, dividend stocks are already drifting, not collapsing, just drifting. Investors shrug. Yields look slightly better than usual. Some people treat that as a buying signal. Then the crisis hits. Fast, hard, indiscriminate. Dividend stocks sell off too, sometimes more than the broader market. But here's where it gets interesting. While prices are falling, yields are rising. Because yield is just the annual dividend divided by the current share price. If the stock falls and the dividend stays the same, the yield goes up. You might have bought at a 3% yield and suddenly it is yielding 6%. That looks attractive. It looks like the market is handing you something. Investors pile in. Financial media runs segments about locking in historically high yields. The logic sounds airtight. And then the dividends get cut. Not every company, but consistently enough that it has its own name in academic finance, the dividend trap. You buy based on a high yield that reflects investor fear, not company health, and then the payment you were counting on disappears. The uncomfortable math. Make this concrete. A company paying $1 per share annually, stock trading at $25, that is a 4% yield, reasonable, stable looking. The market crashes, stock falls to $12. Now that same $1 payment is an 8% yield. In a world where savings accounts pay almost nothing, that is an enormous pull. The narrative writes itself. You are being paid to wait. But here's what the yield number cannot tell you. It cannot tell you whether the company can still afford that dollar, whether revenues have collapsed, whether management is in emergency board calls trying to survive the next 12 months. The yield is a rear-view mirror metric. It reflects what the company paid in the past. It says nothing about what it will pay tomorrow. And when survival is on the table, dividends are the first lever management pulls. Not because they want to, because they have to. In 2020, over 500 S&P 500 companies either reduced or eliminated their dividends. In 2009, S&P 500 dividends per share fell more than 20% year over year. Some sectors fell far more. Financials cut by over 50%. These are not small companies failing in obscurity. These are household names making rational decisions under impossible pressure. The hidden pattern. So here is the actual pattern, not the one printed on fund prospectuses. Before the crash, dividend stocks look like anchors, stability by design. At the start of the crash, they fall in line with everything else, sometimes faster. Mid-crash, their yields spike and attract a second wave of buyers chasing income. Then, the dividend cuts arrive, staggered, spread across weeks and months, each one triggering another sell-off in that specific stock. So the investor who bought during the mid-crash yield spike experiences a double loss. Price continues falling after the cut is announced because the cut removes the income thesis entirely. And the income they were counting on is gone. Two-part wound. Price down, income gone. The thing they bought the stock for ceased to exist at precisely the moment they needed it most. And the timing follows a pattern. Companies almost never cut immediately. They wait. They are hoping the crisis resolves, protecting their reputation for as long as possible. So cuts tend to arrive not in month 1 or 2, but in month 3, 4, 5. By which point, anyone who thought they were buying a discount has been sitting in a declining asset while cuts keep rolling in across the sector. Hype versus reality. Here is the version of this story that gets told in financial media. Dividend stocks outperform over long periods. This is true. Over decades, companies with growing dividend programs have historically produced strong total returns. The research is real. What the long-run data obscures is the sequence of returns problem. If you are a retiree or entered a significant position near the top of a market, the crash experience matters enormously. You cannot smooth over the period where everything went wrong just by looking at the 40-year chart. There is also the survivorship bias problem, which is quietly enormous here. The studies showing how well dividend stocks perform are measuring the ones that survived, not the ones that cut, collapsed, and got quietly removed from the index. The historical data on dividend stocks is, in a meaningful sense, a story about winners told as if it were a story about the average outcome. The winners do exist. Companies that maintained dividends through 2008, through 2020, through every recession in between. Johnson & Johnson, Procter & Gamble. Some consumer staples names paying uninterrupted dividends for 50 years or more. But those companies are the exception that became the marketing story for the entire category. Bigger picture. Step back from individual stocks and look at what this pattern means at a systems level. Dividend investing, as it is commonly marketed, functions on the assumption that the income stream is reliable. Millions of retirees structure their financial lives around that assumption. They hold portfolios weighted heavily toward dividend payers and treat quarterly payments as a salary replacement. When a crash hits and dividends get cut across multiple sectors simultaneously, it does not just affect investment returns, it affects spending behavior. Less dividend income leads to less spending, which leads to weaker corporate revenues, which makes dividends harder to sustain, which leads to more cuts. The thing that was supposed to provide stability becomes part of the mechanism that amplifies the downturn. There is also a concentration risk rarely discussed openly. Because dividend stocks cluster in specific sectors, utilities, consumer staples, real estate, financials, a dividend-heavy portfolio is not as diversified as it looks. In 2020, real estate saw wave after wave of suspended dividends from REITs. In 2008, financials, one of the highest-yielding areas of the market, effectively imploded as a dividend source. So where does that leave you? Dividend stocks are not a fraud. The long-run case for quality dividend growers is real, but the marketing has, for decades, packaged a strategy with specific crash-time vulnerabilities as something close to a free lunch. The pattern is not hidden because it is secret. It is hidden because it is inconvenient. Because the comfortable narrative of getting paid to wait is much easier to sell than the accurate version, which would have to include a section on what happens when the payment stops. The investors who do best with dividend strategies are the ones who understand that the dividend is a signal, not a guarantee. Who watch payout ratios, free cash flow, and balance sheets with the same obsession they apply to yield. Who treat a high yield as a question, not an answer. But most people who own dividend stocks do not do that. They own them for the same reason people buy rain insurance and then leave the umbrella at home. Because the sun was shining when they bought it. The next crash is already somewhere in the future, accumulating quietly. The dividend stocks look stable right now. The yields look reasonable. The companies look healthy. They looked that way last time too.